SpaceX IPO'd on June 12th at $135. 4 days later, it hit $225. Today, it's $125, below the IPO price. History has a number for where this stops, $90. Here's the data. On July 15th, SpaceX closed at $134.85, the first time shares finished a trading day below the $135 IPO price, and CNBC ran it as breaking news. SpaceX stock sinks below IPO price for the first time. That's not a random wobble. It's the exact behavior of the 15 biggest US IPOs of the last 20 years, companies like Facebook, Uber, and Rivian, where nearly every single one followed close to this same script, and the average outcome for that group after one full year on the market was a finish 33% below the IPO price. For SpaceX, that math produces one specific number, $90. This video is the receipts, chart by chart, number by number, and by the end, the $90 target will look less like a guess and more like simple arithmetic. To understand why that number is coming, start with how this IPO was actually built. On June 12, 2026, Space Exploration Technologies, ticker SPCX, priced at $135 per share, selling 555.6 million shares to raise $75 billion, with underwriters led by Goldman Sachs, Morgan Stanley, Bank of America, Citigroup, and JP Morgan. That's the largest IPO in stock market history, beating Saudi Aramco's 2019 record by a wide margin. And it opened with a market capitalization near $1.8 trillion. Day one, the stock closed up 19%, right in line with the average first-day IPO pop for U.S. listings since 1980, according to University of Florida professor Jay Ritter, who has tracked this exact data for decades. By June 16th, just 4 trading days later, SpaceX hit an intraday high of $225.64, a 67% gain from the IPO price, briefly pushing its market cap toward $2.6 trillion. Musk retained over 82% of voting control throughout, and the deal made SpaceX the 7th biggest company in the US by market cap on its very first trading day. That's the setup. Here's what happened next. By late June, the stock had already dropped 23% from its high. Analyst Gary Black publicly said SpaceX was trading near 45 times projected 2026 revenue and called the IPO price too high relative to the company's own forecasts. Then, on July 15th, SpaceX closed at $134.85, the first close below its $135 IPO price since it started trading. As of today, July 18th, the stock trades between $124 and $128, with a 52-week low near $122.12, set earlier this week, and trading volume has stayed well above its daily average the entire way down. That's a 45% collapse from the all-time high in roughly 1 month, one of the fastest post-peak breakdowns of any mega-IPO on record. And it's not happening in isolation. It's happening on a documented, repeatable pattern that mega-cap IPOs have followed for 2 decades. And that pattern is the entire subject of this video. This isn't a random dip, it's a documented pattern. Here's the data. First Trust and Bloomberg compiled it, republished in a Motley Fool analysis dated July 17th, covering the 15 largest US IPOs by market value since 2006, the biggest, most hyped stock debuts of the last 20 years. Across all 15, the average stock fell 50% from its IPO price at some point during year 1, and the average stock finished year 1 33% below its IPO price. Why does this keep happening on the biggest, most professionally underwritten deals on Wall Street? Insider lockup expirations flood the market with hundreds of millions of shares at once. Sky-high hype valuations reset toward actual revenue and earnings. Early institutional buyers lock in profits right as retail investors buy the top. 4 case studies first, using real closing prices and real dates from public SEC filings and market data. Then, SpaceX goes directly on top of the same chart. Case 1. Facebook. May 18, 2012. IPO price, $38, the most hyped tech IPO since Google. Nasdaq's own trading systems broke down under the volume that day, and Facebook later cited that technical glitch in legal filings as a factor that spooked investors and pressured the price. Shares closed nearly flat on day 1, no real pop at all, an early warning sign. Then the collapse began. By August, Facebook's market cap had dropped $50 billion. By September, shares hit $17.55, a 54% crash from the IPO price. The trigger was the lockup expiration. Hundreds of millions of insider shares became sellable starting August 16th, and early investor Peter Thiel alone cashed out roughly $400 million almost immediately. Facebook didn't reclaim its $38 IPO price until July 2013, over a full year later. Analysts at BMO Capital Markets cut their price target from $25 to $15 during the worst of it. Final year one result, down 31%. Same pattern, different trigger. Uber. May 10th, 2019. IPO price, $45. Uber didn't even wait to crash. It opened broken, closing day one at $41.57, down 7.6%, the largest single-day dollar loss in U.S. IPO history at that time. Days later, Uber reported a $1 billion quarterly loss as a newly public company, and shares spent nearly the entire first year trading below the IPO price. Then March 2020 hit, and the COVID crash sent Uber below $15 a share, a 64% max drawdown from the IPO price within the first year. Year one result, down 21%. Uber did eventually recover, crossing $100 a share for the first time in 2025, more than doubling its IPO price years later. But year one was a long, painful bleed for anyone who bought the debut, and Uber's closest public comparison, Lyft, which IPO'd weeks earlier, fell even harder over that same stretch, dragging sentiment down further. Uber's drawdown was steep. Rivian's was worse. November 9th, 2021. IPO price, $78, backed by 20% Amazon ownership and a Ford partnership. Within a week, shares hit $172, up 120%, pushing market cap to $153 billion, roughly 92 times the actual revenue Rivian would generate in 2022. It briefly outvalued Ford and General Motors combined, while selling almost no vehicles at scale. That's the euphoria phase, textbook. Then interest rates rose, production slipped behind targets, and the market stopped paying for hype without profit. Rivian crashed as low as $18.55 within about a year of its IPO, an 80% max drawdown from the IPO price. Year one result, down 67%, one of the single worst mega-IPO debuts on record, and a full 76% below the IPO price at that low point. A stock that briefly outvalued Detroit's two biggest automakers combined, wiped out in under 12 months. One more, outside the official 15 stock data set, but the same script. Alibaba, September 2014. IPO price, $68, set by Jack Ma and SoftBank's Masayoshi Son after roadshow demand pushed the price range higher. It was the largest IPO ever at the time, raising almost $22 billion. Day one, shares popped 38% to close near $94, unlike Facebook's flat, glitch-plagued debut. By November, they peaked near $119, up 75% from the IPO price. Then, right on schedule, the fall began. Lockup expirations, a Yahoo stake spin-off dumping hundreds of millions of shares onto the market, and slowing Chinese growth data. By August 2015, right around its first anniversary as a public company, Alibaba had dropped to $57 to $59, below its own IPO price. Same script, different continent, same ending. A stock investors were told would be a can't-miss trade by every major bank on the deal, trading underwater within 12 months of its debut. Those are 4 detailed examples. Here's the rest of the list, all 15. Coinbase, down 55% in year one. Robinhood, down 74% with an 80% max drawdown. UiPath, down 74%. Coupang, down 62%. Venture Global, down 59%. General Motors, back in 2010, down 36%. DoorDash, down 13%. Rocket Companies, down 19%. Kenvue, down 29%. Visa finished roughly flat. Out of all 15 mega IPOs since 2006, only 2, Airbnb and Snowflake, actually finished year one positive, up 25 and 27% respectively. 2 winners out of 15. Worse, as a group, these 15 giants underperformed the S&P 500 by a median of 129 percentage points since their debut. This is the best covered, most analyst-tracked IPO data available anywhere, and the result is brutal. 13 of 15 mega-IPOs finished year one lower than where they started, regardless of industry, country of listing, or how much hype surrounded the deal. Now put SpaceX on that same chart. Day 1, up 19%, matching the historical average pop exactly. Days 2 through 4, euphoria phase, the stock rockets to $225, up 67%. Directly comparable to Rivian's explosive spike to 172 and Alibaba's run to 119. Weeks 2 through 5, the turn. SpaceX sheds 23% by June 23rd, then keeps grinding lower week after week. By mid-July, just 5 weeks after its IPO, it's already broken below its $135 offering price, a level Uber broke on day 1, but that took Facebook and Alibaba many months to reach. SpaceX is running through this entire boom and bust cycle faster than nearly anything else on the list. It's not a different chart. It's the exact same chart Facebook, Uber, Rivian, and Alibaba all drew, just compressed into a shorter, more violent timeline, moving in weeks what took those stocks months. If SpaceX follows that same line forward from here, here's exactly where the math from this dataset says it goes. 2 numbers matter here. First, the average max drawdown across all 15 stocks was 50% from the IPO price. 50% off SpaceX's $135 IPO price is $67.50, a level it could touch before its first anniversary in June 2027, if it tracks Rivian, Robinhood, or UiPath. Second, and this is the number in the title of this video, the average stock in this dataset finished its first year 33% below its IPO price. 33% off $135 is exactly $90. Not 89, not 91, 90 on the nose. At today's price, near $125, SpaceX is already only about 28% away from that number. History doesn't need a crash from here. It just needs a slow, steady grind lower. The same grind that took Facebook and Alibaba roughly a year to complete. The chart says 90. The valuation says the chart might be right. SpaceX's trailing 12-month revenue is around $19 billion. At the roughly $2 trillion market cap it hit in late June, that's a price-to-sales ratio near 104. Palantir, the most expensive stock in the entire S&P 500, trades around 55 times sales. Nvidia trades closer to 20 times sales. SpaceX was priced at nearly double the most expensive stock in the whole index, while reporting annual net losses in the billions of dollars heading into the IPO. That's a valuation built on flawless, decades-long execution across Starship and Starlink simultaneously. Historically, the exact profile of stock that falls hardest the moment reality, an earnings miss, or an operational delay shows up. And that's precisely the kind of pressure already building this week. 2 more triggers that could speed this up. First, share lockups. Early investors and employees can't sell for a set period after the IPO, and reporting suggests a meaningful chunk of SpaceX's early release eligible shares could stay locked up even longer than originally expected. Historically, whenever lockups do expire, that's exactly when insiders sell in bulk and prices drop hard. Facebook in August 2012, Alibaba about a year later, same mechanism. Second, execution risk on Starship itself. This past week, a Starship V3 test flight carrying 20 next-generation Starlink satellites was scrubbed, with another attempt now targeting the following Monday. SpaceX did get regulatory clearance for its 13th Starship test flight, genuinely good news, but every delay chips away at the flawless execution story this valuation depends on, and markets have historically punished exactly this kind of operational slippage hardest in richly priced, newly public listings with no earnings track record to fall back on. None of that is guaranteed. Here's the other side. History is a pattern, not a promise, and Wall Street isn't uniformly bearish here. 27 analysts currently rate SpaceX a buy against just one sell, with an average 12-month price target near $240, a high estimate of $800, a low estimate of just $62. The bull case is real. Starlink now has more than 8 million subscribers and a revenue run rate north of $12 billion a year. Company-wide revenue grew 43% in 2025 to nearly $19 billion. And SpaceX is reportedly in talks with the Pentagon for billions in dollars of AI cloud computing capacity. The XAI merger, valued near $1.25 trillion, adds another growth engine entirely. Remember Snowflake? It underperformed the S&P 500 for years after its IPO, then beat the market once its price finally caught up to reality in 2024. Proof that a broken chart isn't a permanently broken company. So where does that leave us? History doesn't say SpaceX is a bad company, and it doesn't say Starlink or Starship will fail. It says SpaceX is a wildly overpriced entry point right now, exactly like Facebook, Uber, Rivian, Coinbase, and Robinhood before it. The pattern says $90 is a realistic year-one floor, and $67.50 is possible as an intra-year low if it tracks the average drawdown from this exact dataset. That's not a prediction carved in stone. It's what 20 years of data says tends to happen to stocks like this. And none of this is financial advice, just historical pattern recognition applied to a very new, very expensive stock. If SpaceX breaks the pattern completely, it will be one of maybe 2 or 3 mega-IPOs in 20 years to do it. Would you bet on that? Drop your SpaceX price target for June 2027 in the comments below. Tell me if you think this is the exception to 20 years of data, and subscribe for the follow-up video when we find out who was actually right.